We are talking about assets and so much more around issues around Luna and what they want to do is what we talk about now. For the many people I think it's about over 60, 70 people on the webinar right now. Fantastic that you're here. There's still time because I think the nuts and bolts around investments and growth starts now when we speak to Shabir Munshi and we speak to some of the panelists as well with their own stories. So looking forward to that. So if they've jumped in or they haven't yet jumped in as yet, tell them now, inform them, just share with them the link so they can jump into the space as well. Right, Shabir or Shabs, you're back again, right? Now you've got a presentation, what you got about 25, 30 minutes you want to talk about, right?
Yes, yep.
Okay, so shall I leave it to you? Go ahead.
You can leave it to me. Okay, thank you, Ashraf. That was absolutely a fascinating conversation with Ridwan. Ridwan, really incredible insights that you provided to us, in terms of how numbers matter. And also which other numbers we should be looking at, so a really, really fascinating kind of discussion. So why numbers matter, okay? I'm going to talk to you about that, and actually I'm going to start with a question. If numbers matter, then why do we get cycles in the market, okay? So actually in some ways a little bit of a contradiction to what Ridwan was telling us. And let's see where we end up, in this discussion. Okay, so why do we get cycles in the market? So this picture here shows you the annual returns on the S&P 500. Now, the S&P 500 is basically the index of all the top 500 stocks in the US stock market. Okay, so that is the largest stock market in the world. And on average, over a 65-year period, the average return was approximately 10% per annum. Okay, but if you look at the actual individual years, okay, only in 6 of those 65 years did the average return, did the return for that particular year, was it between 8 and 12%. So in other words, more or less around the 10%. In every other year, it was mostly substantially above that, and in some years, substantially below that. Okay. So it's absolutely fascinating. Why, as an investor, if you had a view that you're going to get 10% per annum, why would you not be happy just accepting 10% per year every single year and getting on with that? Okay, but you don't see that. Okay, and that fascinates us. Okay, and interestingly, recently, I read an article by a guy called Howard Marks. Now, Howard Marks is from a company called Oaktree Capital, and he's certainly one of the great investors, of our time, and one of the guys that I do follow, over and above a few other guys. And basically, what he says is that it's the behavior of investors that actually is a significant driver of the market itself. And what does he mean by that? He says basically, when the market is going up, investors generally conclude that it will keep on going up. Now, if they conclude that it will keep on going up, what would you do? You would keep on buying shares. And if you keep on buying shares, the stock prices will rise. But at some point, that stock price doesn't reflect the underlying earnings of that company. At the end of the day, the value of a stock is represented by its underlying earnings. That's what really drives value, okay? But not necessarily price. And that's the difference between it, right? Between price and value. So as investors think that it's going to keep on going up, the prices go up, and eventually stock prices are rising faster than earnings. And novice investors that are looking back and saying, oh, over the last 3 years, there was a 30%, 40%, 50% return on the stock market. And guess what? They start buying, okay? And eventually you get out of kilter and you get an overvalued market or an overpriced market, okay? And then something happens, okay? And what happens? Typically, it's some external event, like a war, okay? So we've seen it, for example, the Ukraine war. And that triggers something, or there's a corporate failure.
Petrol gets pushed up.
Yes, yes, and that pushes up petrol, and that's an event, and that particular event or a corporate failure, something happens, and then people say, geez, okay, I've been buying the stock, and I'm thinking it was going to go up, and now suddenly there's this war, and, inflation's going to rise, or, you know, that company was a fraud or whatever it is, okay? And that's when the stock market starts, you know, coming down. And in fact, you know, when that starts happening, initially, you know, your average investor is looking at it and saying, no, it's going to come back. You know, it's just down 10%. It's going to come back again from this. And actually what happens is the stock market keeps on going down and down and down. And eventually, you know, the pain of losing, you know, especially when you came in very late in the market and started buying at very high values, that pain starts hurting you and you pull out and you pull out of that market. And eventually, the stock market reaches a bottom, okay? And of course, more or less around that time, and nobody can actually tell where the top or the bottom is of the market, but more or less what happens is that bargain hunters start coming in. Because what has been happening is that earnings start improving relative to stock market prices, and those value investors start coming into the market, and then the cycle starts all over again, okay?
So that point, what behavior determines the market?
So behavior, at certain points in time, behavior determines the market. But eventually, it's the numbers that matter. So in other words, it's the earnings of those underlying companies that eventually matters. And that's when the markets start getting into more rational type.
And you concur with Marx, not be confused with the other Marx by the name of Karl, just sort of
yes,
that, yeah.
Yes, yeah. So I concur that you know, you get this irrationality in the market because firstly because there are people, and people are more often than not driven by emotion, and sometimes there's the loss of pain. In fact, there's many studies that show that people feel much more pain, you know, when they lose $10 than the joy when they gain $10. Okay, so that's absolutely fascinating.
Right.
So,
what else you have?
Yeah. So you can see in this market, in this picture here, which basically shows, you know, what the prices, what prices people are willing to pay. Okay. Now, on average, right, the price earnings ratio is basically an indicator that for every dollar of earnings, how much is somebody willing to pay at a particular point in time? Okay. So on the long-term average on the S&P 500. People were willing to pay $16.50 for every dollar of earnings, okay? And in the recent past, we're talking about the last 20, 25 years, it's closer to 20 or 19.6%. But you can see from this particular graph that there are times when people are paying substantially more, okay? And sometimes it is because they have underestimated you know, the potential of an earnings knock in a company due to fraud or other events, and sometimes people are just you know, willing to you know, just get out of a market at any cost, and actually giving it.
They're all emotional.
It's emotional. It's emotional decisions. Willing to get out of the market, and you can see, for example, those graphs below the red lines are when people are just getting out of the market, you know, and you know, and just because of the pain that they've experienced, and actually right at the wrong times. Okay. So that's you know, that's what that you know, what that graph shows. And John Maynard Keynes, you know, who's you know, who's an economist, you know, one of the renowned economists in the world, and basically says, you know, the markets stay irrational longer than you can stay solvent. Okay, so there is an irrationality in the markets. Okay, and basically what he's saying, he's an economist, he's a numbers person. Basically says that you can determine the value of a stock. Of course, you need to adjust it for the stuff that you don't know, what could happen in the future, and you can make some adjustments related to that, but you can come up with a reasonable valuation. But the market, not everyone does the same thing. And if a whole bunch of people act in a way that says the market's going to keep on going up, or follow somebody on Twitter, okay, you know, that says, this stock is going to go up, and everyone follows that thing, that stock could actually go up, okay?
But that means, I mean, just to understand, are markets manipulated?
Markets can be manipulated. Markets can definitely be manipulated. I mean, we've seen that, for example, in the U.S., you know, recently with, you know, with a certain very famous, you know, entrepreneur, very good entrepreneur, you know, was basically talking up a company called GameStop, okay? And you know, the share price of that company went up substantially, okay? But the underlying value of that business was nowhere near what the stock prices indicated.
Okay. Right, you have more to say, right?
Yeah.
Go ahead.
So how do we at Luna Capital, right? How do we actually start, working through this anomaly, right? We basically are numbers people. We sit there, we look at the balance sheet and the income statement of companies. We look at the macroeconomic scenario. We look at all of these numbers and we come up with a valuation of a company, okay? And at some point we determine that this is the price we are willing to pay for a particular company. But we also have to take into account that the perception of what the broader market has of value. And what does that mean? Okay, so basically, if we are just pure on the numbers side, we could in certain periods of time substantially underperform the market because the stock market may keep on going up quite substantially. Okay, and or alternatively, we might think there's value in a market, but it keeps on going down because there's this negative perception in the market. So we have to stay in the market, okay? And we will always take a particular view. But what we try to do is we try and balance that with what our sense is, of what the perception of value is. And so in other words, how are investors behaving? And if they are behaving in an optimistic way, we also have to try to be a little bit optimistic. Obviously, we can't be so optimistic that we also just buying into overvalued shares because eventually we know that the numbers start mattering and that's going to come down. So that's the first thing that we do. So we certainly have this kind of balance between what's the behavior and the perception of value, number one, and what is the actual value, the way that we assess it. The second thing that we do is certainly we stick to our competencies. Okay, so in other words, we have certain investment themes that are driven by our understanding of the market. Okay, so for example, we think that technology is a significant driver of growth. Okay, over the long term, it creates efficiencies in companies, it creates new products, it creates new services. It disrupts existing environments. I mean, to talk about, for example, renewable energies versus the fossil fuel type energy type. Those things are drivers of potential growth over the long term. So we like
magic number 4 IR. I mean, I think people need
correct
to get that.
4 IR, right? So we like technology as a growth sector, and particularly, for example, the semiconductor industry. There's just this demand, significant demand for more and more semiconductors. In the world, cybersecurity, as more and more people get online. Okay, the cloud, the drive towards cloud, even healthcare. We certainly in the latter part of our ages, Ashraf, maybe I can talk about myself, maybe not you. But certainly, as we get older, and as population, I mean, Ridwan showed us some statistics there, right? And basically, people are living longer, and the longer people live, the more healthcare they need, okay? And obviously there's significant innovation taking place in that particular industry, okay? 5G, the millennials, let's talk about the millennials. We talked about the silvers, we call them the silvers, people that got silver hair, if they have any hair. But the millennials, the young people, they have different way of doing things. They are digital natives, so they probably buy more things online than they actually go into physical shops for. Okay, absolutely. They look for experiences. So they are, as opposed to physical kind of goods. Even the way that they dress. We used to buy a suit that lasted us for 10 years. They buy stuff that they throw away in a few, in a few weeks. They wear it 3 or 4 times and they throw it away. So it's very different. And, so we look at those particular trends and look at which companies can benefit from that. Okay. And then the third thing is that when you are in a market like we have at the moment, where it is difficult and prices have come down, and there's this big war going on, and there's this fear of recession and all of those things, we take that opportunity to kind of just step back a little bit, not to panic in a situation. Step back a little bit, look at our portfolio, at that point in time, see what we, see what we are invested in. Try to think about what should we be having in our portfolio that's going to be incredibly good in 2 years' time, because suddenly these opportunities are now, because we can buy those stocks at a substantially lower price than they were 6 or 10 months ago. Everyone rushes to a sale when Woolies has a sale, but when the stock market has a sale, okay, everyone runs away from it. Okay, in fact, so that's what. So when we see these things, we see opportunity, and of course, it doesn't mean that there isn't risk.
There has to be that risk.
There has to be that risk, and you have to take that, and you have to take that. You have to take that view, going forward. So the key point, really, what I'm saying is that we've got these three things that we look at: value and perception of value. Stick to our knitting. And think 2 years ahead, about where we could see great returns on our portfolio.
Just on that part of when you say don't panic, and I think it's an important one. You've been using the word we often enough.
Yeah.
Now you head up Luna Capital, but who's we in the Brains Trust that makes decisions? Because I would just think that, goodness, for you to make all those decisions on behalf of investors on a day-to-day basis, like, wow, what a responsibility.
So we is, it's my board of directors. They definitely are a key part of our investment strategy. So every 6 months we present an investment strategy to the board. They give us their ideas. We work through that, and then we work we work through that, and basically that's what we generally stick with, right? Then what we've got is we've got a smaller group of 4 of us. I mentioned Vijay, boss, he's part of that. Carl, he's part of that. And Danielle, is also, part of that. So basically, we meet twice a week, on a Monday and on a Friday, where we have a specific investment committee. So if there's an idea that we've got, we present it, we do the analysis, we present the analysis, and we take those decisions. So that's basically it. And ultimately, the decisions do lie with me, but I have to listen to everyone's views, and sometimes I disagree with them, and live the consequences, and that's the way that it is, So
but the track record, and I know you have more to say, but the track record would suggest that you, as a company, you're winning for your investors more than you're losing.
Absolutely, right? Yeah, absolutely. So what we do is we've got an allocation model. Now this is the allocation model that I show you for the Luna, the Luna Fund, the Luna Capital, the Luna BCI Worldwide Flexible Fund. But it's a similar strategy for the for the offshore portfolio, except that there we don't have any local investments. It's only foreign investments. But basically, what we do is we group it into 4 buckets. Okay. And what are the 4 buckets? Okay, basically we talk about large cap. So large cap is these large companies, high quality companies that have significant value. So about between 50 to 60% of our portfolio is in that camp. So for example, Berkshire Hathaway, Amazon, Microsoft, a company called ASML, who are manufacturers of the equipment to make semiconductors. It's a Dutch-based company. Sanlam, Shoprite. I'm not going to run through all of that, but just to give you a sense of what sits in that portfolio, for that large high quality. Then we also have about 20 to 30% of our portfolio in what we call mid-cap, shares. And mid-cap is like your middle cap companies that potentially have a growth. They've got good revenues. They're still growing. They've got good margins, and potentially, could become large cap companies. Okay, and then we look for those disruptor type companies. Okay, so small companies that are, we look at that and we see that technology is quite interesting.
The potential for massive growth.
Massive growth, or it's driving a particular industry. So, for example, there's a company there called CrowdStrike. And that basically, is a cybersecurity company. Lululemon, which is a company that's in this luxury athletics wear kind of business. So we think that those kinds of companies, could potentially become, significant, over time. Obviously, they're a little bit more riskier, but that's why we don't take big positions in that. And then lastly, we always sit with a number of cash and bonds. So I mean, what's important there is that we try not to have, less than, about 70 to 75%. In the stock market at any point in time. So when we see the risk is high, we are around 70%. When we see the opportunities are there, we're closer to 95%. Okay, and then of that, offshore in the Luna Fund, between 55 to 70% is offshore, mainly in the US, and then local, obviously 30 to 45%, depending on where we see the opportunities. And as I said, in the Luna offshore portfolio, it's basically 100% offshore, and there. We are more broadly spread, so it's not only US, it's in some of the other jurisdictions.
Those that form part of the large cap, I mean, the cost per investment is far bigger, right? Cost
Correct.
per share.
Yes.
But the risk is lower.
The risk generally is lower. Obviously, those companies, they could be overpriced, but generally the risk is lower.
Okay. That's not all. You have more to say. Go ahead.
Yeah. So this just gives you a sense of, some of our top 10 holdings. It's a split. You can see, the gold is basically the offshore investments. The blue is the local investments. So Berkshire we've talked about, FirstRand, Vodacom, ShopRite. The themes. Think about the themes that I've talked about. The iShares Biotech ETF. Okay, ASML, Amazon, Alphabet, Walmart. One of the largest retailers in the world. Doing some interesting stuff from a technology point of view. So there you go. That just gives you a sense of where our thinking is. In the Luna Fund. Okay. This gives you a sense of our return over the 5-year period. Okay, so we've been in existence for 6 years. So over the 5-year, we like to look at long-term investments, and in the long term, basically we've given an average of 7.43% per annum, and a total return of about 43% over that period. And that is despite, you can see that in the graph, despite the knock that we've took, since the beginning of this year. And really, again, we see this
as year precipitated by
overvaluation, number one, and then obviously triggered by Ukraine. And the oil prices, and now in fact the central banks raising interest rates, which makes the potential for a recession higher. Okay.
And here's a quick one: Ukraine versus COVID-19 in terms of impact.
So interestingly, COVID-19 in March 2019, March 2020, when COVID was starting to rapidly increase, there was a significant drop in the market, but the market rose from there onwards incredibly over that period. So if you were smart enough to have invested at that part of the bottom of the market, you were probably up over 100% in less than 2 years.
Wow. Okay.
Incredible run in the market. I don't think I've got the graph for that, but that's given you a sense of it. So that's where. Whereas Ukraine, the impact is still there. So for example, the US market is down about 20%. The NASDAQ market, which is where we focus on more technology, down about 30%. Even the JSE is down, about 15% over that period. Okay. Yeah. So, we talk in numbers, right? And we talked about performance. So let's talk. Let's give you the full view, right? Over a 6-year period, 41% return. 5 years we've talked about, and in the last year. So in other words, from the 1st of July, 2021 to today, we are down about 8%. And I looked at, for example, what is the difference, say, for example, in the NASDAQ and the JSE. And in those two markets, the JSE was flat over that period, and the NASDAQ is down, over 16% over that period. In fact, I think it's closer to 18 or 19% over that period.
I'm thinking about people in the audience, investors or new investors. wanting to know what do they do next, and hopefully you can share that with us in the 8 minutes or so we have remaining, right?
I'll give you some sense on it. So that gives you the sense of performance, you know.
Yeah.
But our measure, so these are the reason I put numbers here. So why numbers matter? So for us, what matters? Which numbers matter for us? Of course, performance is the core, okay, of what matters for us, okay. But we also like to measure other things, okay. For example, AUM means assets under management. So how much assets do we have under management? So we've got about 118 million of assets under management, of which 113 is in the Luna BCI Worldwide Flexible Fund. That's a unit trust, of which, and that unit trust is available to all investors. You know, the minimum a lump sum investment is 5,000 Rand, and you know, and you can go, you know, as low as you want to. You know, maybe 100 Rand is too little. So I would recommend something, you know, around 500 Rands per month on a debit order. You know, so that, you know, that's available to almost anyone, you know, that can afford 500 Rands a month, you know, for themselves, for their kids, for their, you know, for their long-term investments. Okay. Then the second product that we've got is our Luna Offshore Portfolio Management product. We've got about 6 clients in that, you know, with $330,000. In fact, we've got a little bit more because we've got, you know, a few new clients that came through this, you know, this month. But that's basically what we've got, you know, at that point in time. There, the minimum investment, you know, is really is for high net worth individuals. So you're really looking at a minimum of about 500,000 Rand, you know, per client, and all of it is offshore. You need to use your forex allowance to be able to do that. Okay, so. You know, that's our, actually, probably, I mean, our core measure is assets under management, because assets under management comes from performance. If the fund performs well, the assets under management go, we get more clients, you know, that also drives it. And then, of course, it's about clients. You know, how many clients do we have? You know, so you know, at this point in time, we have 158 active clients. And actually, last year, when we spoke, okay, we were, you know, we were on 100 clients. So we've grown our clients. 58% growth, yeah.
Almost 60%.
Yeah. So 58% growth in our clients over the last year. Okay.
Well,
so
that's fantastic.
Yeah. So that's, you know, and the split, you know, between men and women, or males and females, 51-49%. We've got 10 companies in there. And I try to kind of, you know, we're very much a family oriented wealth kind of business, you know. And the impact that we have there is on about 105 families. And I think it's larger than that, because in some of those companies, you know, there are groups of families that, you know, that have basically, you know, come together in a Stokvel type situation and invested in it.
And I gather now you're getting generational investors.
That's what we are trying to get to, yes. And in fact, in some of our clients, we've got, you know, grandfather, grandmother, you know, their children and their grandchildren, you know, so... You know, that's just like, I mean, that's just fantastic for us, you know. So, and we've got a few of those, and that, you know, and they know they can phone us anytime. They know, we know that. How are you measuring
yourself? Obviously, the skeptic would say, okay, great that you're doing that. Now, how do you measure yourself? We're talking numbers against others who do similar things to you.
Yeah. So we find ourselves as being a very personalized business. Okay. So people can phone us at any point in time. They give us. I mean, you know, kids will phone us. They want advice on their investments. We help them through that, okay? I mean, I'll talk a little bit about that just now. In fact, let me maybe take you...
All right, you've probably got about 4 minutes.
I've got 4 minutes. So you asked the question, okay, so what do investors do now, okay? And what I want to show you in this graph, okay, sorry, I don't have a pointer, but basically, look at the periods of growth after a big drop in the market. So... If you look at, for example, 1975, so between 74 and 75, you see that big drop, okay? There you see a 37%, 23, 24% growth. Okay, another small negative year, but you see a period of significant growth, okay? Look at the period during the global financial crisis, 2008, okay, that minus 36.5. Look at the growth during that particular period, okay? So... Okay, what we can't tell you is that there isn't going to be another negative year. But what we can tell you is that if you are not invested, when that turn comes, okay, you are not going to be part of it. Okay. That's the message.
So you're not shopping during the sales. you'll miss out on the big deals.
Absolutely, yeah. That's really the key point here, okay? And it's, of course, we're not trying to predict that there's going to be, super growth here, etc. But you have to give yourself the opportunity, to try and participate, where the growth is going to, when the growth is going to be there, okay? It's not to say that there isn't risk, and of course, we need to understand that as well. But at the end of the day, that's part of our job, is to try and assess at which point do we go more aggressive into the market versus less aggressive into the market.
Is there anything more you have to tell us? Yeah, you do, of course.
Yeah. So just maybe one or two slides that I want to get through. Okay, this really just shows, for example, 10 year stints, of what you see. Okay. And in almost every period, you can see, every 10-year period, you can see significant growth in the market. Yeah. Okay. And in fact, in the last 10 years, so for example, from 2011 to 2021, there's a 368% growth in the S&P 500. Now, of course, that growth, I'm showing up until 2021, and of course, it's come down somewhat from that. Okay. And the point is that yes, it might come down a little bit more. Okay. But you can see over a 10-year period there is a potential to grow. Okay. Lastly, I just you say why with us and why not with. So we have three parts of our strategy. Learn. We are evangelists for investing. We will. You phone us. You want to talk about shares or investing? We'll talk to you forever. Okay. We share our insights. We write blogs. We've recently launched a weekly roundup. That we put up, and we give you a view, of
and people must be informed. I mean, therefore,
absolutely, yeah. So if they follow us, for example, on our mailing list, okay, and if they want to, they can just go into our website, follow us on our mailing list. They'll get all of that. We've had family wealth building workshops, the family balance sheet. I mean, people will talk about that. The other thing that we did was that last year we launched the Youth Academy, right? That we run for free. We guinea pigged, three individuals. One of them now, is working for Luna Capital, and the other two are absolute, in fact, all three of them are absolute ambassadors, for Luna Capital. And we had, our first batch of formal intakes this year. We've completed that first 10-course session over the next 6 months, and in fact, we've just agreed the next batch that will start on the 23rd of July, for the next batch. And actually, some of the youth in that academy were about 61 years old, or 62 years old. Okay, so, so we call it youth. It's all about that.
They've been around, yeah.
Okay. Invest. I mean, our core philosophy is growth at a reasonable price. Okay. What I want to say is that every single director and shareholder is invested in the fund, in the Luna Fund. Obviously, we can't do the offshore because those are for individual portfolios of the individual people. But we put our own money. We believe we must have skin in the game. And I can tell you that when the markets come down, we feel the pain. And when the growth comes, we feel the pain.
As shareholders.
Absolutely. As investors in the fund itself. Yeah. As investors in the fund itself. Okay. So, we see that. Okay. And as I said, we've got the two products, and really what we want is, get other investors to co-invest with us. And about enjoyment, we love what we do. We're passionate about it. We want to make an impact in people's lives. We want them to learn about investing, to build wealth for themselves. And at the end of the day, our greatest joy will be, if our clients make money and they can use that for the stuff that they enjoy, that will be our joy.
And I mean, that's the point. The money or the wealth opens up avenues to other aspects of a lifestyle that you wouldn't ordinarily have. Right?
Absolutely. Yeah.
Maybe that's where the enjoyment comes in.
Yeah.
Just if we're going to wrap up now, just the last thing, unless you have more to say, and maybe this is a pitch to your own base, but also to potentially new investors, right? What's the magic for you around Luna Capital? Why does it work?
Why does it work for us? Okay, so firstly, as I said, we have skin in the game. Okay, so we are. We have our own money in the fund. We have been investing, as I said, right up in the beginning. In my case, certainly for over 30 years. Okay, I've been investing in the markets. All of our directors bring specific experience. Whether it's telecoms, technology, healthcare, investments, quantitative kind of skills. All of that, you know, we bring that to the party. We are available on a personalized basis, you know, for an investor that is willing to invest 1,000 rand with us or 5 million rand with us. Okay, so, you know, we make ourselves available, you know, for that. And the other thing is we want to make an impact on not only that person's investments, but, you know, in their families.
Well, I think you certainly have done that.